You probably think valuing your business is complicated, like Wall Street stuff, something only investment bankers or finance bros with spreadsheets and suits could possibly understand. But what if I told you you can value your business in under 10 minutes without ever touching Excel? In this video, I'll walk you through a simple 3-step formula that anyone can use to figure out what their business is worth, and also show you how I used to value my business. But before I share that, here's a common problem I see with most founders these days. They spend years building their business, but when it's time to sell and a potential buyer walks in with a figure, entrepreneurs have no idea whether it's a fair deal or they're getting lowball. And that's where most deals go sideways. They feel unsure, the buyer senses it, and they end up taking less than what their business is really worth. And most times, it's not because the business is not valuable, it's because they, the founders, don't know how to show it. They don't know how and what buyers are looking for, or how they're thinking about value. So instead of leading the conversation, business owners start reacting to it. And that's not a position you want to be in, especially when the stakes are this high. So let's fix that. Step 1, how buyers decide what to pay. Now, this question almost always comes down to one thing. What multiple do I apply to the profit? By multiple, we mean how many times your yearly profit am I willing to pay to buy the whole thing? Let me give you a quick example to explain this. Let's say your business makes $500,000 in profit and the buyer prices 3 times multiple. That makes your business worth around a $1.5 million business. Simple math. But the tricky part is figuring out the right multiple. Now, there is a general rule of thumb that most buyers follow. If your profit is under $500,000, they'll usually pay anywhere from 2 to 4 times that amount. If your profit is between $500,000 and $1 million, you're looking at a range of about 2 to 5 times. And once your profit hits the 1 to 5 million mark, the multiples usually land somewhere between 2 and 6 times. Sounds pretty straightforward, right? But here's where things get interesting. Let me give you 2 real-world examples that show you why it's not just about the profit number, it's about what's behind that number. First, you got Publicis, one of the biggest agency groups in the world. They acquired a company called Influential, a fast-growing marketing agency in the influencer space, for almost $500 million. But why such a big number? Well, Influential had a strong recurring revenue, great client retention, and most importantly, they had over 20% profit margins, and they were still growing fast. Buyers loved that. Now compare that to another deal, a company called Be Heard Group. They were acquired for just over £6 million, even though their EBITDA was close to $5 million. So what happened here? Basically, Be Heard had weak margins around 8% and there wasn't much growth. So even with a decent profit number, the valuation stayed low. The buyer applied a smaller multiple because the fundamentals weren't exciting. And that's the key takeaway here. Buyers aren't just paying for how much money your business made last year, they're paying for how much money they can make next year and the year after that. So when they see strong margins and growth, that multiple goes up, and when they don't, it drops fast. This is how valuation isn't just about top line numbers. It's about profitable growth. That's the foundation for everything we'll cover next. But before we talk about valuation, let's first talk about how to calculate your profit properly in the first place. That's step 2. Find your real profit number. And let me clarify this right now. What most people call profit is usually just the raw number sitting at the bottom of the income statement. But that number on its own does not tell the full story. And if you just hand that to a buyer without adjusting it, you're likely undervaluing your business without even knowing it. So what buyers actually look for is something called adjusted EBITDA. And for smaller businesses, they might use a slightly different term, that's SDE, which stands for Seller's Discretionary Earnings. Now, don't let me throw you off with big technical terms here. SDE is just a way of showing the total benefit the new owner would get from the business. So that includes your profit plus your own salary and anything else you expense through the business that a new owner probably wouldn't keep. In simple terms, it's basically what would this business be making if we stripped out all the future unrelated stuff and one-off costs. Let me break it down with a few real examples so you can understand this a bit better. Let's say your business made $300,000 last year, but in that same year, you also paid yourself a salary of $100,000. You hired a ghostwriter to help with LinkedIn posts, maybe another $30,000. You spent on ads, software tools, maybe even a few business trips that were experimental, going after an industry vertical you did not end up unlocking. All of that adds up, and the buyer isn't going to keep most of those expenses when they take over. So what do? We add it back to your profit, and that adjusted number, let's say it's now 500,000 instead of 300,000. That is the number a buyer will multiply to come up with your valuation. This is where most owners miss out because they only look at the profit that shows up in the accounting software. But buyers look at adjusted profit. They're asking, how much cash is this thing really generating once I own it? So when you do this properly, your valuation can go up a lot. Sometimes by hundreds of thousands just from knowing what to include. That's why I put together a simple template that includes all the typical IBEX buyers expect, plus space for you to plug in your own numbers and calculate your adjusted profit. I leave the link to download that model down below, so make sure you check it out. Step 3. What impacts your valuation? Alright, so now you know how buyers decide what to pay and how to calculate your real profit. But there's one last piece that brings it all together. What actually influences the multiple you get? Because two businesses with the same profit can get completely different valuations, all depending on these 7 things. Let's break them down real quick. Number 1, margins. The higher your margins, the more profitable every dollar of revenue is. And that's probably the first thing buyers notice. Number 2, growth. Are you scaling fast or just surviving? Growth signals future upside and buyers pay a premium for it. Otherwise, it seems too risky for an investment. Number 3, industry trends. Are you in a market that's growing or shrinking? Trends impact risk and risk impacts value. Number 4, revenue quality. Recurring revenue is more valuable than one-off projects. If your clients pay monthly and stick around, that instantly makes the business super attractive. Number 5, client concentration. If most of your revenue comes from 1 or 2 clients, that's risky. Buyers want and prefer diversified clientele. Number 6, operational efficiency. Can your business run without you? Are systems in place? The less owner dependent it is, the more attractive it becomes. And number 7, market conditions. Interest rates, deal flow, and general market sentiment all affect how aggressive buyers are. Now let me show you a quick real-world example of how this plays out. WPP, one of the largest agency groups in the world, is trading at around 5 times EBITDA. Why? Because their growth was basically flat. Publicis, on the other hand, is growing around 6% a year, and they're trading at over 7 times EBITDA. Same industry, same business model, but that small growth difference leads to a much higher valuation. So even small shifts in these drivers can move your multiple up or down. And that's why understanding these 7 levers is so important. Because now you can actually do something about them and start shaping your business into one buyers want to pay more for. So now you know how buyers price your business, but that's only one side of the equation. The real power comes when you understand how to increase that number. Because once you know how and what your business is worth today, the smart move is figuring out how to make it worth a lot more, sometimes without even growing revenue. In the next video, I'll show you how to do exactly that, from improving margins to reducing risk to making a business more attractive to premium buyers. So if you're serious about building a more valuable, exit-ready business, make sure to subscribe, hit the bell, and don't miss out what's coming next.